Mahesh, good to have you back. How are things? Haven't seen you on the channel in a while. I thought you
Hello.
could hear me. Hi Mahesh, is my voice reaching you?
Yeah. Good morning. Good morning.
How are things? Haven't seen you on the channel on a while in a while.
Yeah. Things are fine. Yeah, doing great. Yeah, markets are also fine.
Are they fine? Because last 2 years the returns have not been fine.
Yeah, last 18 months they have been flat, but I think it's gone through a period of consolidation, right? And earlier, I mean, there was concerns that the markets valuations were expensive, right? While growth was good. I think the good thing is that the valuations are now corrected to more reasonable levels. There is some concerns about growth slowing down, earnings downward, but still, I think we are in a period where we're seeing decent earnings growth, at least in double digits, even next year. And I think a lot of the fears about high inflation, interest rate hikes are now kind of looking behind us. So I think while the market might not do too much from a short-term perspective, I think it's creating a good now kind of a support, okay, for making the next move or a medium to long term.
Mahesh, what could be the trigger here? Because earnings are not exactly expanding. Metals are numbers have topped out. IT numbers have topped out. For banks, base effect has kicked in. So, are we really in for a good earnings trajectory?
Yeah, I think while there have been some disappointments, I think we saw in the IT sector there was disappointment which was kind of expected, but not to that extent what we're looking at. And there is some slowdown in the consumer discretionary side. I think the numbers have been mixed, but by and large, I think if you look at there have, like for example, if you large sector, like for example, banking and financials numbers, very few numbers have come out, but look to be fairly on track over there. Even in sector like domestic engineering, capital goods sector, numbers look good. Even in cement, I think you should see improvement from what we saw in the previous quarter. And amongst the global cyclicals, even metals, okay, where there have been, I mean, last quarter was a fairly bad quarter. There also, sequentially, we are looking improvement in terms of the pricing environment now with China opening up. So I would say that by and large, even for next year, even after the numbers what we are coming, we've seen around just about 2 to 3% downgrades to earnings. I mean, earlier the earning expectation growth was around 16% or so. That will probably be around 12, 13% in that range, which is not bad in the current context where we are seeing global growth, especially in the developed markets where the growth is more or less flat.
Mahesh, every large fund has a overweight on financials. That's one space where growth is visible. That's one space where NPA problems are not there. But when we speak to the top bankers in India, Axis Bank or SBI, all of them are talking about a moderation in FY24. Are markets prepared for a moderation in credit growth or profits?
You're right. I think because I think while the GDP growth might not, in real terms, might not come down so much, but in nominal terms, okay, there will be a quite a bit decline because the inflation, which was especially WPI, which was driving nominal GDP growth very strong, I think that will come down dramatically in FY24. So we're expecting nominal GDP growth to be actually somewhere in the high single digits, right? And to that extent, credit growth will also normalize. But I think to large extent, I think I would say that is factored in because if you look at the valuations, okay, in the banking space, they are not really demanding. I mean, they are most of the banks will probably be near the long-term average or slightly below that. And mind you, I think overall the profitability trajectory for the banks is much better than what it was during the pre-COVID levels. So both the ROAs, the NIMs, while NIMs could see some kind of a impact as the transmission of the benefit of the increasing the interest rates. Initially, you benefit on the asset side, but as the liabilities cost move up, you will see some compression over there. But despite that, I think we expect overall NIMs and the ROEs to be much better than the pre-COVID level. I think that would probably justify better returns or better valuations for the banking and financial services sector. And to that extent, I don't see much of a concern. I think markets are already starting talking about a lower nominal GDP, while credit growth, which is around last year was around 15-16%. We're expecting that to be around 11% or so in FY24.
Mahesh, I'm curious to find out what is it that you've done within your funds when it comes to IT? Because, most funds have ownership within the IT pack, and especially after the disappointment that TCS and Infosys have been, have you reduced weightage there?
No, we have not done much. Actually, we were slightly underweight the IT sector. Okay, we were not too negative also on the sector because we think that this is a kind of a transitionary period. Over a medium term, we still expect the sector to do reasonably well with good cash flows, with good earnings yield. We don't see much of a downside over there. Obviously, the growth is missing, so it's not exciting sector really to be in. But there are challenges across various sectors. So given that we were slightly underweight, and we continue to maintain that, I think post the recent correction, what we have seen, now I think the stocks seem to have actually bottomed out, at least from a valuation perspective. Okay, now it's a question about what the earnings growth is going to be. And here again, I think we are seeing some kind of a divergence there. I think it's a few companies recently reported are showing reasonably good growth or probably meeting their guidance. There have been some disappointments. So we'll have to wait and see. But I would say that I mean, at this point in time, we are kind of neutralish on the sector. We're not really too negative because valuations are already now corrected to levels slightly above the pre-COVID levels, but really factoring in some of the slowdown which is expected.
Interesting. Any contra calls that you may have in this current market, especially after the fall up until March 29th and the recovery thereof? For instance, one is seeing FMCG, pharma kind of sectors make a comeback.
Yeah, so I think in contrary sectors like consumer discretionary, consumer durables, retail, we have seen marked slowdown there in the last quarter and possibly in this quarter also. There has also been a meaningful correction in some of these names which were quite expensive earlier. I think structurally, I think India, we expect discretionary consumption to increase as a percentage of total consumption because of the rising per capita income, premiumization, which is happening. And this could be a good opportunity in this correction where the numbers are likely to disappoint to look at that sector from a longer term perspective. Pharma is another sector which has kind of underperformed after rallying after the post-COVID wave. We have seen numbers kind of a disappointing, especially in the US generic space. Again, there also what we hear is that the pricing pressure which was there in the US generic space is slightly easing off. There is still price declines, but the pace of decline is now reducing as there is some amount of consolidation happening on the supply side. So I think that again is a sector which can be a good counter call considering the fact that there also the valuations of the large companies are fairly reasonable compared to their historical averages.
Let you go on that note. Appreciate you taking the time out, Mahesh, and joining in, sharing with us your outlook on the markets. Let's